Welcome to the HDIN Research 2026 Strategic Outlook. Today, we will examine the global acrylic acid and derivatives market. We are currently observing a critical industry shift, moving from an era defined by rapid-scale expansion toward one characterized by technological premiums and a mandatory green transition. Our analysis provides a roadmap for navigating these structural changes over the next 5 years. Starting with the executive summary, the industry is navigating a significant oversupply phase. Following the supply constraints of 2021, massive capacity additions, particularly in China, have created a glut. Consequently, leading players like Shanghai Huayi and Satellite Chemical are pivoting. Their strategy is shifting from volume-driven growth to a value-at-stake approach, prioritizing high-purity and bio-based derivatives to protect margins. To understand the situation, let's look at the industry scale. Global capacity is reaching 9.5 million tons, with China now accounting for over half of total output. While the value chain is traditionally anchored in SAP and butyl acrylate, we are seeing a strategic migration toward high-purity electronic-grade monomers, which serve as high-margin stabilizers for the broader portfolio. This chart illustrates the capacity trajectory from 2020 to 2026. The steep incline between 2024 and 2025 represents a significant supply shock. This rapid expansion has outpaced the recovery of global demand, creating a structural mismatch that is currently weighing on global operating rates. Benchmarking the top-tier players reveals diverse strategies. BASF remains the global leader through its Verbund integration, focusing on low-carbon footprints. Meanwhile, Asian players like Shanghai Huayi and Satellite Chemical have rapidly scaled up, achieving cost leadership through massive, integrated production bases. Focusing on the complication, China's capacity reached 4.4 million tons in early 2025. With nearly 36% potential overcapacity, the market is experiencing intense price competition. This has forced domestic producers to aggressively target export markets in Latin America and India to maintain plant utilization. The financial consequence of this glut is margin erosion. Spot prices have approached a 5-year floor, barely covering variable costs for non-integrated producers. At HDIN Research, we anticipate that 2026 will be a year of structural elimination, where high-cost, inefficient assets may be forced into permanent closure. Beyond supply issues, trade barriers are rising. The EU's CBAM introduces carbon tariffs that demand rigorous certification. Simultaneously, anti-dumping measures in regions like Brazil and India are complicating the traditional export-led growth model for major producers. Demographic shifts are also altering demand patterns for superabsorbent polymers. While the baby diaper segment is slowing due to lower birth rates in key regions, we see a robust increase in demand for adult incontinence products, driven by aging populations in developed economies and China. This brings us to the central question. In an environment of overcapacity and increasing carbon taxes, how can chemical leaders escape the commodity trap and ensure long-term sustainability? One answer lies in technological innovation, specifically one-step propane oxidation. By bypassing the propylene stage, producers can achieve significant feedstock cost savings, estimated at $400 per ton. This route is being pioneered by early adopters to secure cost leadership. Simultaneously, a premiumization strategy is essential. Leaders are targeting ultra-high purity niches, such as electronic-grade AA for semiconductor photoresists. These specialty applications offer a refuge from the price volatility of general-purpose grades. The transition to bio-based acrylic acid represents the next frontier. Using 3-HP fermentation routes, companies can decouple from fossil fuel volatility and command a carbon premium. This is increasingly vital for supplying global brands in the luxury, cosmetic, and hygiene sectors. Digital transformation is also playing a key role. AI-driven smart manufacturing allows for real-time yield optimization and predictive maintenance. This not only lowers operational costs, but is also becoming a requirement for meeting 2026 carbon peak mandates. Looking at Satellite Chemical, they have committed over 25 billion RMB to high-end diversification. Their pivot into the Lianyungang alpha-olefin park demonstrates how traditional AA producers can integrate into the electric vehicle and advanced polymer supply chains. Shanghai Huayi's 1350 strategy focuses on building world-class integrated hubs. By leveraging the Qinzhou base, they are diversifying into advanced materials and green tires, ensuring the group can withstand regional market cycles through horizontal and vertical integration. Geographically, while China is the supply center, the India engine is the primary demand absorber. With an 18.5% CAGR, the Indian market is critical. Success here requires navigating, local content rules and establishing strong regional partnerships. Financially, the industry must remain resilient in a low-margin era. While net margins are expected to average around 3.8% in 2025, firms with strong balance sheets, like HDIN, are maintaining stable credit ratings by managing their debt-to-asset ratios carefully during this CapEx cycle. Environmental, social, and governance goals are no longer optional. The roadmap toward 2050 carbon neutrality includes increasing the share of green power and expanding polymer recycling capabilities. These ESG metrics are increasingly tied to the cost of capital for global chemical firms. In conclusion, we expect a new equilibrium to emerge by 2027. The market will likely split into three distinct tiers: cost-led commodity players, R&D-focused specialty leaders, and large-scale integrated firms using acrylic acid as a foundation for advanced high-margin materials. Thank you for your attention. This concludes our strategic overview. For more detailed market research or custom consulting regarding these findings, please contact our team at HDIN Research. We welcome your questions.